How much time do I have, Marty?
You've got 25 minutes.
Okay, good. All right. Well, when Marty was asking you folks for subjects, as I said, you came up with all the good ones, and they could certainly take a lot of time to for us to discuss. I'm not sure that I heard anybody mention Omicron, the new variant of COVID. Maybe I missed that, but clearly that was top of mind on Friday. And I think we need to address that based on the very limited information that's been available since Friday and over the weekend. I'm assuming that Omicron is comparable to the Delta variant of the COVID virus, in which case we're going to learn to live with it. And I'm under the assuming so far that the mRNA technology that so rapidly came up with a vaccine for first COVID Alpha and then COVID Delta will also be useful in fighting off the worst aspects of the Omicron virus. And there's a reason to believe that the drug makers, well, the drug makers said on Friday, Pfizer and Moderna both said that they could have a targeted kind of vaccine available in a very short period of time. So in some ways, I guess there's an analogy with the flu, where the flu is always comes out in various different variants, and we have to sort of guess which ones are going to be most predominant and design the flu vaccine around that guess. And sometimes it's a good guess, and sometimes it's not so good, and people do die from the flu, as we know. But it certainly looks as though this virus is going to be with us for a long time, and that we're just going to have to live with it. And with the vaccines and with the treatments and the pills that the drug companies have come up with, I think that's a plausible scenario. Now, speaking of plausible scenarios from an economic standpoint and an investment standpoint, looking at next year and looking beyond that to the rest of the decade, you folks are long-term investors, so I like to put everything within the context of a big picture, longer-term outlook. And I think there's two alternative scenarios, and doesn't mean it's got to be one or the other. It could be a mix. It could be one predominates for a while and then the other one takes over. But in terms of what I see as likely alternatives, one is, as somebody mentioned, we need to discuss inflation. There are certainly aspects of the current situation which are very reminiscent of what happened in the 1970s with the great inflation of that period. That the great inflation of that period actually started around the mid 1960s and kept going in the 70s until the early 80s. We saw that we were running a war with rising deficits, which contributed to inflation. In the early 70s, Nixon went off the gold standard, which depressed the dollar. The weakness in the dollar boosted commodity prices. We saw food prices going up. We saw energy prices going up. We saw Fed Chairman Arthur Burns saying that pay no attention to food and energy. Let's just look at the core CPI. And that didn't work for very long because the core CPI started to really take off. And some of that was because labor unions were very powerful back then. A lot of them had cost of living adjustments. So when food and energy prices went up, it very quickly showed up in wages. And as wages increased, companies had a choice, and that was to pass those costs through into prices or increase productivity. And the reality is productivity collapsed during the 1970s. In 1965, productivity was running about 4%. By the end of the 70s, it was zero. So companies naturally responded to the rising labor cost of wages, not with an increase in productivity, but rather with increasing prices. So we had a wage price spiral. And again, there's a lot of similarities between what we're seeing now and back then. You must say, well, we're not seeing cost of living adjustments. Well, that's not the case anymore. The Deere contract for 10,000 workers a Deere now includes a COLA that gets triggered every quarter. So unions are making a comeback. We've got a very pro-union administration, pro-labor administration. And on top of all that, we've got a serious chronic labor shortage. And that labor shortage, people have come up with all sorts of short-term explanations for the labor shortages and why they may not persist. But if you look at the underlying demography, you'll see that in fact, the growth of the working age population and therefore the labor force has come down substantially, dramatically, to something in the order of 0 to 0.5%. So the labor force just isn't growing, and it's a structural problem. Baby boomers the oldest turned 65 in 2011. They're now turning 75. A lot of baby boomers like myself are still working, want to work, but the old gray mare she ain't what she used to be. As you get older, at some point you may decide that it's time to retire. And then there's plenty of baby boomers who maybe had some free time during the lockdowns last year to think about the meaning of life and decided it's time to stop working. It's time to start traveling, enjoying life better, exercising, being with your family. And we are seeing more seniors retire at a faster pace and not being replaced rapidly enough by new entrants into the labor market, again, because of demographic factors. So we were seeing that labor shortage before the pandemic. The unemployment rate got to 3.5% across the board. Many segments of the labor force were enjoying great times, prosperity. Wages were starting to go up. Then the pandemic hits, and coming out of it, or whatever we're doing right now, it's becoming pretty clear to more and more businesses that the labor shortages are chronic. They're structural. They're not going to go away, and so you've got to deal with it. Clearly, you have to pay workers more. You've got to hug them and make them feel good and tell them how important they are. You want to keep the labor force you have, and that's getting to be difficult because we know quits are at an all-time record high. But you clearly got to pay them more, give them more benefits and a better standard of living. That's expensive. And if you can't increase your productivity, you have really not much choice but to increase your price if you can, or else watch your profit margin fizzle away. I think companies are going to respond to the labor shortages with a tremendous productivity boom. I have a chart here I want to share with you. There's a bunch of charts, so we really don't have time. But this is sort of the most important chart, if I can find it. Yep. Okay, first of all, let me say that I think companies will respond to the chronic labor shortages with technology. I think you need to look at your portfolio and ask yourself, is every company I own in this portfolio, is it a technology company? Now that might sound pretty wacky to you. It's like, what, do you want me to have 100% in technology? That's not what I'm saying. What I'm saying is you certainly want to have a lot of exposure in the technology sector per se. But then again, any company you own in consumer discretionary and healthcare and financials, et cetera, you want to ask yourself, are they using technology? They're using innovation? Are they actually innovating technologies to increase their productivity, the productivity of their workers, both manual and mental? And as you can see in figure 7 here, technology spending as a portion of overall current dollar capital spending has been increasing quite dramatically. And you can see we're already at a record over 50% of current dollar capital spending is now going to technology. And that's an understatement, because this includes IT equipment, software, and R&D. It does not include things like machinery, industrial machinery, which we know has a tremendous amount of technology embedded in it, both hardware and software. And it does not include consumer technology. And as we know, especially now with COVID, the technology revolution is an integrated revolution. It's one that has brought businesses and the consumer and workers more together than ever through the cloud, through remote computing, and then soon quantum computing. All these technologies are already there. They were getting implemented, but I think the COVID pandemic accelerated the pace at which these technologies are being used. And again, if you're looking at companies that aren't doing that, they're not going to stay in business for very long. The Wall Street Journal, I think it was either this weekend or late last week, had an article about get rid of your IT department. And I think what they were really getting at is that the IT really has to be an integrated part of your business. It's not a department. It's not something that's separate. And then you ask the IT people to come in and can you design something for this and that. It has to be fully integrated. The way technology is fully integrated in manufacturing. Manufacturing, to a large extent, has become a technology industry. So here's what I'm looking for in terms of productivity. And this is the alternative to the Great Inflation 2.0. The alternative to the Great Inflation 2.0 is the roaring 2020s, in which technology really makes a huge difference in productivity. And productivity, the arithmetic of productivity is pretty straightforward. Real GDP is equal to the growth in productivity. The growth in real GDP is equal to the growth in productivity plus the growth in the labor force. And if the growth in the labor force is bupkis, as we say here in New York, if it's nothing, then real GDP growth is going to be nothing unless productivity makes a comeback. Well, as you can see by the red line, which is actually a 20.25% change at an annual rate in productivity to kind of smooth it out, to get rid of some of the volatility, and to get to see what the pattern is in the cycle of productivity. You can see that we had a productivity boom in the late 40s, early 50s. We had a productivity boom in the 60s. And again, when you're looking at this point, it's not that that just happened in a point in time. It's the average over the previous 5 years. So it was a great period of productivity. We saw productivity collapse in the 70s, as I said. Some attempt here to see an improvement, but that didn't last long because of globalization leading to deindustrialization in the US. And then let me just move the chart back. And then you can see we had another productivity boom in the late 90s and early 2000s. But in some ways, that productivity boom was very narrow. It really was a productivity boom in the technology sector. The technology sector produced a lot of computers and a lot of software. And if your company could use Excel spreadsheets and Word, those technologies certainly increased your productivity. But overall productivity wasn't getting a big boost from the technology revolution back here. And as you can see, maybe just integrating it and trying to figure out how to use it might actually have weighed on productivity here. For one reason or another, productivity actually weakened here. And again, I think some of it was deindustrialization and companies spending more money on increasing their productivity and their facilities overseas than here in the US. But it's actually started to change. And it started to change not too long ago. In 2015, we got down to 0.6% as the annualized 5-year productivity growth, which is pathetic. But look at this, we've been up to 2%. We had a setback in the third quarter because of supply disruptions in supply chains. But productivity has already started to make a comeback. And I think it's going to 4%, which sounds crazy until you stare at the charts and say that's certainly plausible. It's happened before. And in many ways, the technology revolution we have now has got to be far more powerful in increasing productivity across the board in just about every industry. Hence, get rid of your IT department and incorporate technology in everything you do in your business, no matter what your business is. Now, there's an interesting correlation here, which is probably one of the few things that you might have studied in economics that makes sense and you can actually see in a chart. And that is the workers get paid their productivity. It's not a trickle-down theory. It's just a reality in a competitive marketplace. Inflation-adjusted wages are tied to productivity. Productivity sets the standard of living, sets the purchasing power of consumers, and therefore their buying power. And so you can see a very tight fit between those two cycles. And I think wages are going to continue to go up. But it's pointless to see wages go up if it's completely offset by prices, which is kind of what we've seen in the past few months here, kind of deja vu all over again with the wage price spiral of the 1970s. But I think we're going to find increasingly that wages are going to grow faster than prices, and that price inflation simmers down. So my inflation target range is 4 to 5% between now and the middle of next year on a year-over-year basis in the consumption deflator, and something like 3 to 4% in inflation next year. Now, some of you might say, well, that's still above the Fed's 2%. Isn't the Fed going to be raising interest rates a lot and cause a recession and kind of make this all the potentially good that could happen here disappear? Well, I think it's important to recognize that we have a very liberal Fed, very woke, very progressive Fed. I don't know what happened to Jerome Powell, but somebody who has a Wall Street background, who seemed to be a financial conservative for a while, seemed to have changed pretty radically with the pandemic. And I think he's also a politician, and the politics has become more liberal, more progressive, more woke, and so has the Fed. And the Fed has put more emphasis now on getting the unemployment rate down than worrying about inflation. But the Fed is starting to worry about inflation because it's getting a little out of hand. And so I think they are going to be raising interest rates after they stop tapering, after they accelerate the pace at which they reduce the rate at which they purchase securities. And I do think we're going to get not 3, but 2 rate hikes next year. A lot of people are thinking 3 rate hikes, but I think the Fed's going to raise. It's going to move the goalposts. It's going to raise the inflation target, in my opinion, from 2% to 3%, and conclude that they're willing to live with 3% inflation rather than take a risk that if they tighten too much, they'll cause another recession. So again, it doesn't have to be one or the other. It doesn't have to be the great inflation 2.0. It doesn't have to be the roaring 2020s. It could be some mix thereof. But I think looking out over the rest of the decade, I think the technology revolution is going to win over. Economists have a very long history of being dismal in their outlook, being depressing, looking for bad things to happen. And I think what they always miss is technology revolutions. Thomas Malthus, back in the late 1700s, saw doom and gloom for us because we were multiplying faster than the food was available. And he said all that just before the great agricultural revolution of the 1800s. Malthusians in the 1960s were very doom and gloom. And we had another agricultural revolution with the Green Revolution. Now, obviously, there's a tremendous amount of doom and gloom about climate change. I think technology is already working on solving a lot of these problems without having a radically painful transition from fossil to windmills and renewables. I think I'm seeing signs that we're going to be very pleasantly surprised by the progress we make in nuclear energy. And I'm not talking about fission, I'm talking about fusion. There's been a lot of breakthroughs in fusion and nuclear power just in the past couple of years. They've been working on it for years. It's just they keep getting stymied by one thing or another. But now there's some new technologies, particularly in superconducting magnets, that are necessary to contain the fusion reaction that seem to be extremely promising. And so I think that the roaring 2020s could be followed by the perpetually sunny decades over the century ahead, where we could actually look forward to plentiful available energy that doesn't have the downside of nuclear fission and is basically generated from plentiful supplies of water and hydrogen and helium. And that, of course, will help to accelerate the EV revolution, the electronic vehicle revolution, but I think we still have a ways to go in making some technological innovations in batteries. Once that happens, combine that with cheap electricity, and you really are talking about a roaring 2020s for the rest of the decade, because the roaring 2020s really was it was technology that made it that caused it all to roar. Now, of course, it ended badly with a depression and with a stock market crash. But I'm bullish on the stock market. I think it'll go up along with earnings, and so I'm using 4,800 by the end of this year, 5,200 by the end of next year, 5,500 by the end of 2023. The bond yield, I think it should go to 2%. I've been thinking that for a while, but I've been surprised like everybody else that hasn't gone there. But I think it's going to go to 2%, and that's a quick overview of the way I see things.
Ed, do you see the Fed raising rates?
Yeah, I think the Fed will raise rates 2 times next year, not 3 times, and I think they'll raise their inflation target from 3 to 4%. They'll live with more of it.
Right. Any questions from the audience here? Yeah. Yes.
I'm sorry.
Of course, yeah.
So Ed, here's the thing. Everything you said made sense, except internally, I'm trying to figure out. The Fed helped avoid a Great Depression through COVID, which seems like it could easily have happened, and they kept the market from plummeting, or it plummeted and came right back. And you don't think we're going to have long-term inflation? So isn't Jerome Powell a hero? Well, it seems like you have a very negative view of him, but it seems like he's really steered the ship skillfully under your way of looking at the world.
Boy, here I'm talking about how great technology is, and the auto component here wasn't all that good, but I think what I heard is concerns about inflation being more of a longer term problem, and interest rates being negative in Europe and still being close to zero in the US. There's potential for rates.
But the question is Jerome Powell a hero for steering?
Oh, is Jerome Powell a hero? And I wrote, before I wrote this book, I wrote a book called Fed Watching. And there's a chapter in there about Powell, and it's called Jerome Powell, Pragmatic Pivoter. He's pragmatic, and he has pivoted just in a fairly pragmatic fashion, so that things have worked out. I don't know if I'd say he's a hero. I think the Fed has taken on way too many responsibilities, not just for inflation and unemployment, but it's now talking about having some influence on climate change, and I think that's going a bit too far. And I think Powell has been too woke with regards to the mandate. I think he's given unemployment too much weight relative to inflation. I think inflation will be somewhat less of a problem if it wasn't for his being too easy. The supply chain disruptions they didn't just come out of nowhere. They're certainly related to a demand shock that was exacerbated by the Fed. But look, he's not the only policymaker in Washington. I think the big mistake was the $1,400 checks back in March. I think that's what really put demand on a shocking path that shocked the supply chain. But he's pragmatic.
Yeah, just a quick question here. So I think you're enthusiastic about the U.S., but what about the rest of the industrialized countries? Any thoughts?
Yeah, well, I'm probably the last person you want to ask that, because I've been very biased and right for quite some time. So that means I'm probably going to miss the turn here. But if you look at figure 25 here, you can see that this is the ratio of the US MSCI to the all country world ex-US, both in dollars and in local currencies. And I've been promoting for years, since almost the beginning of the bull market, that you should overweight the US relative to the rest of the world. Stay home has been my motto rather than go global. Doesn't mean you don't invest overseas, but you overweight the US, and that's been working out like a charm even recently. I'm feeling a little nervous about it because it's worked for so long, but I'm sticking with it. I think the U.S. has a very diversified industrial base. For all the crazy things going on here, we still have the rule of law. We still have contracts. We have a tremendous technology industry. We have a tremendous VC, venture capital, private equity business. The rich have gotten richer, but they seem to constantly want to get even richer by taking their money and investing it in new technologies, which benefit everybody. And so I wish that liberals would understand that, and that's the point of my book. But I'd continue to overweight the U.S.
Fantastic. Great. Any other questions for Ed?
By the way, on Bitcoin and the other cryptocurrencies, I'm old school. I think that it's all just it's a tulip mania, and it's the big difference is the tulip mania was just in Amsterdam, and it kind of fizzled out pretty quickly. This is an amazing tulip mania because it's 24/7 and it's global, so it could go for. I'm old school. I need earnings, I need dividends, I need rent, I need interest, I need coupons, I need something I can discount and value. There's nothing that I have that gives me any way to value this. And the argument for Bitcoin is it's mined very slowly. The supply is very limited. Central banks can't manipulate it. That's true, but look at all the current competitive currencies, cryptocurrencies that are occurring there. So the supply of cryptocurrency certainly isn't limited.
I have my thoughts on crypto, but so I just we're separating blockchain from, Bitcoin
Sure.
from blockchain, because blockchain is a technology.
That makes sense. That makes sense.
Because I think blockchain is going to be very revolutionary for banking and fintech.
Yeah, and it goes back to the idea of you want to invest in technology across the board. So the markets have figured it out now. So we have things like fintech and medtech, and everything's has got tech after it. That makes sense.
Yeah, I think the issue, again, just my worldview on Bitcoin, because our group has been in Bitcoin since 2014, with Pantera, who's going to be speaking tomorrow, is that, so if you live through hyperinflationary countries, it's great if you have, as long as somebody will redeem your Bitcoin, it makes a lot of sense, right? So if you take your pay in South America, actually this happened. We had a guy come here in 2015 who was giving out free Bitcoin, and then he sold like $1 million of it to some Latin American family office back in 2015, and they did pretty well with it. And they were living through hyperinflationary times with Colombia and Venezuela, because that's where they were out of.
Yeah.
So it actually worked out pretty well, because I think that
I'm not arguing that. I mean, clearly people have made money in it. That's for sure. I just have no tools for valuing it.
Yeah, one more question.
What are your thoughts on linking sustainability targets to natural financing?
Linking sustainability to credit risk and financing? Any thoughts?
Well, recessions historically have been caused by credit crunches. But coming out of recessions, everybody is careful, and then after a few years, they forget the recession. They start to believe that the boom is going to last forever, and they start to speculate. And then the Fed starts raising interest rates, and you get a credit crunch. I mean, right now the credit markets are telling you that it's free sailing, it's free money, credit spreads remain extremely tight. I watch the credit spreads very closely because they are great indicators of financial stress. The problem is they tell you the day of, they don't give you like a few weeks notice. But they're definitely worth watching. And right now they're still reach for yield, and that keeps the stock market going and keeps valuations high.
We have one more question.
And linking credit spreads to sustainability.
Should you link? So we're actually going to do a panel on energy, the counter reformation of. So there's a lot of problems with sustainability, especially in solar, because of the waste byproduct, and same with wind. So the most common phrase that's used is, well, you can power the whole United States with 1% of the whole land mass of the U.S. covered with solar panels. But that's 50 million acres, right? So 50 million acres of solar panels,
yeah,
which are you have to dispose every 10 to 20 years. It's a tremendous waste. Even the global Renewable Energy Consortium has said that they expect there to be twice as much solar panel waste by 2050 than there is plastic waste. So, I think this is a tremendous issue, but we're going to cover, sustainability later. Yeah,
Okay.
question.
So in regard to Bitcoins, apart from the vulnerability because of the lack of a real pricing mechanism, except for the market, is there a vulnerability because of regulation?
Yeah.
Yeah,
I think that's the biggest risk for the cryptocurrencies, that the central banks get jealous and get concerned that it's becoming a competitive threat to their power. I'm totally flabbergasted. I'm surprised. I'm shocked that the Fed hasn't done something about it already. I mean, I don't understand. And the other central bankers, I don't know why there isn't a bit euro, a bit yen, and a bit dollar. I mean, there could be, and they just seem to be late to the game. And the later they are, the more they're creating a potential for a real calamity. Because if you have everybody concluding that this is where you want to be, and suddenly the central bank said no, we're not going to let you be there. And Bitcoin funds a lot of illegal activity. People say, well, so do dollars, but hey, that's another discussion for another time.
On the Bitcoin illegal activity is that, Wachovia laundered $500 billion.
Yeah.
Money, right?
Yeah.
Actually, on the Miami.
Again, I don't. I'm not volunteering to be a panelist on a Bitcoin or cryptocurrency.
So my argument for Bitcoin, and I'll just leave it at that, is that there's a lot of countries that have no currency that's tradable.
That's fine.
They all want their payment in dollars. Now they want it in Bitcoin or dollars, right?
Marty, just let me throw in one last commercial here. If any of you would like to try my research on a complimentary basis for a few weeks, just go to Yardeni, YARDENI.com. And if you're an entrepreneurial capitalist and you want to feel warm and fuzzy about everything you've accomplished, read my book on Praise of Profits and share it with your liberal friends.